Hi, everyone. Well, thanks for having me here. Can you hear me? Just make sure. Okay. My slides actually have a lot on them, and I thought we could use them right now, and then also for the panel questions. I thought I would just point out some of the major elements there that kind of tie in with what we're talking about, and also don't duplicate what some of the other panel members have certainly spoken about. My background is electronic trading from a very early time. As a matter of fact, I brought Lehman Brothers from a manual voice-based environment to an electronic environment. I was on the original FIX committee, which some of you may or may not know what FIX is, but that was the trading protocol that was invented to allow the buy side to send an order electronically to the sell side, and then the sell side to go out and execute, and those fills to go back to the buy side, which led to post-trade analysis, etc. So we have full pre- and post-trade STP, which is straight-through processing. And that's quite key. And I'm going to really sort of talk about the synergies between equities and fixed income where they make sense. And let me just very much say where they make sense. So the early days were quite interesting because why did we go electronic? It was absolutely, the driver was transparency. But who were the drivers of this? And the drivers were the buy side. The buy side were the ones who said, look, we want more informed decisions. We want performance, evidence-based execution. And the sell side said, okay, well, we'll get together with you in a room or on a committee. And we literally all sat in rooms, various different buy sides and sell sides throughout the City of London, and came up with how you could do cross-border electronic trading, all the way to the point of who owns the order legally when, etc. And also, you couldn't have that without the advancements in technology. So the rise of order management systems and, of course, the FIX protocol itself. Now the drivers, transparency is definitely needed, but the drivers are different. Now we have regulators saying, you know, you have to have transparency. And that's very much driven by the market crisis. I mean, what happened with Lehman going down, and then, of course, the liquidity crunch in 2008, 2009. So those are the drivers for transparency today. Okay, this is a busy one, but I'm just going to point out some sort of pertinent issues here. My whole theory on transparency is look at it with what's helpful and what's harmful. And that's really the key, and really to keep that thought in your head the entire time. And also, hurtful or harmful to whom? And we always seem to talk about transparency on the sell side. And quite frankly, everyone needs to be thinking about the buy side when you're talking about why you're doing transparency or why not. Because all of your pensions are controlled by, or most of you, pension fund managers, and the pension fund managers use fund managers, and then the fund managers use the sell side to execute. So how your fund is performing is very much on how well they actually execute. So that's, I think, what everyone has to keep tantamount in their heads when they're going through all this decision making and thinking about things. And of course, it doesn't help the fact that the sell side did use, hopefully this will work, such words as dark. Dark sounds shady, something's going on, somebody's doing something not right. Take dark, change it forevermore, and use anonymous. Anonymous that's what happens in dark pools, whether it's buy side, sell side, or a combination of both. People don't know who the other side is, and you're trying to prevent market impact and information leakage. And that is the whole point of going into something called a dark pool or any dark mechanism. Is just anonymous. They don't know who the other side is, and it's also not impacting the market. Algos sort of do the same thing. They take large orders and break it up into slices. And so that helps with market impact. Again, helping the buy side. Now, the reason why I'm putting this and making markets liquid, and I have all of these here, is again, this is what works in the market today, but it doesn't mean it doesn't need some sort of controls. So I think that's what we need to look at. And also, what can work in equities, or what does work in equities today, can actually work in fixed income, in liquid bonds. So to get back to what Niall was talking about, sorry. But IOIs, for some of you may or may not know, that's how you source liquidity in equities. It's indications of interest. Now, bonds do not have that, but they do to a certain degree in, for instance, Bloomberg or TradeWeb, in some of those. So there is an element that's similar to equities, and I think that's something that can be much more built on for liquid fixed income instruments. And let's use what we did in equities, in fixed income, again, where it makes sense. Okay. And just to another bugaboo, I'm just going to mention this because I know everyone's talking about broker crossing networks. Again, buy sides are big users of broker crossing networks. They wouldn't be using broker crossing networks if they did not benefit them. Because broker crossing networks, you can do a little bit of everything up above there. And it all depends on what type of order you have that you need to place with the sell side and what helps you the most. Again, the buy side needs choice, and that's what we've got to remember and give them. Otherwise, it hurts us in the end. Okay. Now, again, that's sort of transparency. When do we not need transparency, and when is it harmful? Well, obviously, large and scale is pretty much the biggest example of that. Large and scale can mean a couple of things, though. It's not just a large order. It's also illiquid. So it can be something that's rarely traded, or possibly something where there are not a lot of market makers in. So if you go to the fixed income side, something where you have very few people making prices on it. If they're not going to go in that market, if they always have to be transparent, they're not going to make a price, because the minute they make a price, it will hurt them. Okay, so that's a case of where transparency is hurting you. Okay, so.